You work hard, you earn money. You save what you can. And you assume that as long as you are responsible, your financial future is safe. But what if your money is quietly losing value, even while it is sitting in your bank account? That's what high inflation does. And the most dangerous part, it doesn't feel like theft. There is no alert, no deduction, no visible collapse, just gradual erosion. You wake up one day and groceries cost more, gas costs more, rent increases, insurance premiums rise, and your paycheck? It barely moved. Today, we're going to break down how inflation makes your money worth less, how it affects your purchasing power, your salary, your savings, your investments, your debt, and the entire financial system, block by block. And once you see it clearly, you'll understand why ignoring inflation is one of the most expensive financial mistakes people make. Let's start simple. Inflation is not just prices going up. Inflation is the decline of purchasing power. If last year $100 bought a full cart of groceries, and this year it only buys 90% of that cart, your money lost value. The number didn't change. The power did. That's the key difference. Your bank balance can stay the same while your wealth declines, and most people don't notice because the number on the screen hasn't changed. But wealth is not the number. Wealth is what that number can buy. Now imagine your salary stays at $50,000 per year. Sounds stable. But inflation rises to 8%. That means everything you buy costs 8% more on average. If your salary does not increase by at least 8%, you are effectively earning less in real terms. Even if you receive a 3% raise, you are still 5% behind inflation. That gap compounds. 1 year might feel manageable. 3 years changes your lifestyle. 5 years changes your financial stability. Inflation is not loud. It is persistent. Now, let's talk about savings. If you keep $20,000 in a savings account earning 1% interest while inflation runs at 7%, you are losing 6% in real value every year. That means your purchasing power shrinks, even though the account balance grows slightly. This is why inflation is often called a hidden tax. It reduces real wealth without visible subtraction. You think you heben Safi, but in high inflation environments, idle cash becomes vulnerable. Now, add debt into the picture. When inflation rises, central banks often increase interest rates to slow the economy and control price growth. Higher interest rates make borrowing more expensive. Credit card rates rise. Adjustable mortgage payments increase. Business loans become costly. So while your purchasing power declines, your borrowing costs may increase. That creates pressure from both sides. Income loses strength. Debt gains weight. And financial flexibility shrinks. Here's where it becomes psychological. When inflation stays high, people expect prices to continue rising. So they rush purchases. Businesses raise prices in anticipation of higher costs. Workers demand higher wages. Suppliers increase quotes. Expectations create momentum. Inflation becomes partly behavioral. Confidence shifts. Spending patterns change. And once expectations are embedded, inflation becomes harder to control. Now ask yourself something important. If your salary stopped growing tomorrow, but your expenses continued rising, how long could you maintain your lifestyle without stress? 6 months? 1 year? Less. This is why inflation matters more than people think. It's not about price tags. It's about margin. Financial margin is the space between income and expenses. Inflation compresses that space. Let's visualize it with blocks. Imagine each block represents $1,000 of purchasing power. You stack 50 blocks. That represents your annual income. Now inflation removes 4 blocks over time. You issue 50 blocks physically, but their buying power equals 46. The stack looks stable. but it's lighter. If inflation continues, more blocks lose strength unless you actively add new blocks through income growth, investments, or asset appreciation. Your structure weakens. Inflation doesn't knock the tower down. It hollows it out. Now let's talk about investments. When inflation rises, traditional savings struggle. Investors often shift into assets that can outpace inflation. Stocks, real estate, commodities, businesses. Because these assets can increase in nominal value when prices rise. Cash cannot. Inflation punishes inactivity. It rewards strategic positioning. But here's the trade-off. To fight inflation, central banks raise interest rates. Higher interest rates slow economic growth. Slower growth can trigger recession. So high inflation increases the risk of economic slowdown. Now your money is under pressure from two directions: erosion from inflation, instability from potential recession. This is why inflation is not just a price issue. It's a system issue. Who benefits from inflation? Debtors with fixed-rate loans can benefit. If you locked in a low mortgage rate and inflation rises, you repay that debt with cheaper dollars over time. But lenders lose. Savers lose. Fixed-income retirees lose. Inflation redistributes wealth. It transfers purchasing power. And most people don't realize which side they are on. Now, think long-term. If inflation averages 6 to 8% for several years, the cumulative effect is massive. Prices don't just rise once, they rise again and again. Compounding works both ways. Investment returns compound wealth. Inflation compounds erosion. The longer it runs above wage growth, the deeper the impact. Here is the mistake many people make. They assume stability because nothing dramatic happened. No job loss, no collapse, no emergency. But quietly, their savings lost value. Their purchasing power declined. Their financial cushion shrank. And when an actual crisis hits, they realize they were weaker than they thought. Inflation doesn't destroy money overnight. It weakens resilience. You cannot control inflation, but you can control response. You can increase skills and income capacity. You can understand interest rate cycles. You can reduce high-interest debt exposure. You can allocate assets intelligently. You can avoid panic. The difference between reacting emotionally and responding strategically determines whether inflation erodes you or simply pressures you. Inflation is not just an economic statistic. It changes behavior. It shifts wealth. It pressures systems. And if you ignore it, it quietly reduces your financial power. But once you understand how purchasing power works, once you see how interest rates connect, once you recognize how inflation compounds, you stop treating money as a number and you start treating it as structure. And structure can be reinforced block by block. Now, let's go deeper, because high inflation does not just reduce purchasing power, it changes financial behavior across the entire economy. Let's imagine inflation stays at 8% for 3 consecutive years. Year 1, prices rise noticeably. People complain, salaries lag. Year 2, companies adjust pricing models. Contracts increase automatically. Rent escalates faster. Insurance recalculates premiums. Year 3, what used to feel temporary now feels normal. That's the danger. Inflation normalizes, and once it becomes embedded in expectations, reversing it becomes painful. Now let's talk about wage growth. People often say, wages are rising too. But here's the key difference. Nominal wages can rise while real wages fall. If your salary increases from $60,000 to $63,000, that's a 5% increase. If inflation is running at 9%, you lost 4% in real purchasing power. Over time, that difference compounds. After 5 years of consistent mismatch between wage growth and inflation, the gap becomes structural. That's when middle-income households feel squeezed. They don't collapse. They Compress. Lifestyle adjustments happen quietly. Dining out less. Travel less. Postponing purchases. Reducing investment contributions. That behavioral shift feeds back into economic slowdown. Inflation doesn't just affect numbers. It affects lifestyle. Now let's examine savings erosion in real terms. If inflation runs at 8% annually, your purchasing power halves roughly every 9 years. That means if you hold $100,000 entirely in cash without growth in less than a decade, it effectively buys what $50,000 buys today. That's not dramatic. That's mathematical. And most people underestimate time. Inflation works slowly, but slowly multiplied by years becomes enormous. Now, let's connect inflation with the stock market. High inflation increases uncertainty. Companies face rising input costs. Energy costs increase. Raw materials increase. Labor costs increase. Profit margins compress. Investors become cautious. Stock valuations fluctuate. Some sectors benefit, others suffer. Inflation reshapes capital allocation. It does not affect all industries equally. Energy may rise. Consumer discretionary may fall. Technology may struggle under higher interest rates. Inflation creates rotation inside the market. If you don't understand that, volatility feels random. But it isn't random. It's structural. Now, let's bring interest rates back into the picture. When inflation rises too high, central banks raise interest rates aggressively. Higher interest rates increase borrowing costs. Higher borrowing costs reduce spending. Reduced spending slows economic growth. If growth slows too much, recession risk increases. So inflation increases the probability of economic slowdown. Now think about that. High inflation reduces your purchasing power. Higher interest rates increase your debt burden. Slower growth reduces job security. Inflation doesn't operate alone. It triggers a chain reaction. Now, consider fixed income retirees. If someone relies on fixed pension payments that do not adjust fully for inflation, their real income declines every year. A retiree earning $40,000 per year may see prices rise 7 to 8% annually. Unless benefits are indexed perfectly, purchasing power shrinks. Healthcare costs rise. Energy costs rise. Food costs rise. Fixed income becomes fragile under sustained inflation. This is why inflation disproportionately harms savers and retirees. Now ask yourself something critical. If inflation remains elevated for several years, what happens to long-term financial planning? Retirement projections change. College savings goals shift. Real estate affordability changes. Every financial model assumes certain inflation levels. When inflation exceeds expectations, projections break. Financial planning must adjust. That's why understanding inflation is not optional. It's foundational. Let's visualize this again with blocks. Imagine 3 towers. Tower 1 represents your income. Tower 2 represents your expenses. Tower 3 represents your savings. Under stable inflation, income and expenses grow slowly and proportionally. Savings grows gradually. Under high inflation, expense tower grows rapidly. Income tower grows slowly. Savings tower shrinks in real value. Eventually, the expense tower overtakes income. That's when stress appears. Not suddenly. Gradually. Block by block. Now here's the FOMO part. Most people ignore. Inflation doesn't wait for you to act. Every year you delay adaptation. Compounding works against you. If your money grows at 2%, but inflation runs at 7%, you are 5% behind annually. 5% compounded over 10 years is massive. That gap represents lost opportunity, lost wealth accumulation, lost financial freedom, and you don't feel it daily. You feel it later, when catching up becomes harder. This is why high inflation environments reward financial literacy. Understanding interest rates, understanding asset allocation, understanding purchasing power, understanding debt structure. Without that awareness, inflation quietly redistributes wealth away from those who stay passive. Now, let's address the biggest misconception. Some people say inflation reduces debt burden because you repay with cheaper dollars. That's true only if your income rises with inflation. If your wages stagnate, but your adjustable rate debt rises, you lose. Context matters. Structure matters. Not all debt benefits equally. Not all assets protect equally. Inflation rewards positioning, not optimism. So here's the structural truth. Inflation reduces real value. Real value determines purchasing power. Purchasing power determines standard of living. Standard of living determines stability. So inflation directly influences stability, not abstractly. Personally, and once you understand that, you stop treating inflation as background noise. You treat it as a force that requires strategy. Block by block.